Hey everyone, this is Kirk here again at Option Alpha, and in this video I want to walk through a bull put spread profit calculation. You might also hear people call this a put credit spread. That's another name they give to it, or a short put spread. Again, it's a lot of different names that you might hear besides bull put spread, but essentially it's all the same stuff. So however you look at it, whatever name you give it, it's all the same calculations that we're going to go through. And so we're going to start here with just this structure of a payoff diagram. So we have our zero barrier or break-even point, and then we have positive, which is making money, and we have negative, which is losing money. And of course, a bull put spreads payoff diagram looks like the following, right? It has these two pivot points. These pivot points are the points at which you would sell or buy different contracts. So in this case, you might sell a put option contract here at a strike price of, say, $50. And down here, you might buy the one put option contract at a lower strike price of, say, $45. So in this case, we have a nice $5 wide spread. We sold a put option here. We bought a put option at a lower strike price, and we're hoping to take advantage of the market either moving sideways or the stock potentially continuing to go higher, maybe even go lower, just not below our break-even point. So in this case, let's assume that we trade this position and the stock at the time of entry is at $60 per share. So that's where the stock is here, and we sell a bull put spread slightly out of the money. And again, we're trying to take advantage of maybe the stock staying exactly where it is, going lower, but not below our break evens, or potentially going anywhere higher. So that's why they call it a bull put spread. So to figure out how much money we can make on this position, the first thing we have to understand is that, one, we have absolutely defined risk, or defined profit and defined risk, which means that no matter where the stock trades, if the stock trades anywhere above our first strike price of $50, that is where we make the most amount of money possible, but we really can't make any more than that. There's no, payoff diagram where we have increasing profits as the stock goes higher. We just simply collect our credit and we take the entire credit as profit, and we hope that that's the case in this particular trade. Now, to figure out this amount that we can potentially make on this position is actually fairly simple. All you're going to do is you're going to take the net credit that you collected on both of the contracts when you sold the position to start. So you take the price of the contract where you sold the 50 strike put option. Let's say that you collected a credit of $3 for that position, and the price of the contract that you had to buy to create the spread. Let's say that cost you, so you have a negative sign. Let's say that cost you $1.50 to buy that particular contract. The net difference between those two is that you took in a net credit of $1.50 on this particular bull put spread. So again, the $3 credit that you collected from selling the strike at 50, the put option at the 50 strike, and you subtract the cost of buying the put option at the 45 strike, that leaves you with a net credit in your account still of $1.50. That ends up being your total max profit in the case of the stock trading anywhere above this 50 strike here at expiration. So to use our example, if the stock currently is trading at $60 and ends all the way up here at $66, we still make our whole $150 profit. If the stock actually goes down and trades down to $50.12, just above our strike price here, we make our entire full profit. Anything between 50 and 45, obviously you can see, has varying degrees as you start to shift from one contract to the other. So the slope of this line obviously suggests that as you start to go below 50 and you start to approach 45, as far as a closing price in the stock, then your profit goes down and down and down beyond your break-even point, to the point at which you have defined risk. So again, it's really easy to figure out exactly what the total profit potential is on a bull put spread. It is simply the credit that you collected on the contracts when you entered the position. So hopefully this helps out. As always, if you guys have any other questions, let us know. And until next time, happy trading.